Stellar XLM, trillions to cryptos and stocks, cryptos like Stellar XLM with the Fed yield curve control. Now, what do I mean by that and how am I deriving at that? Well, firstly, you need to understand the actual importance of the bond market. The bond market is the leading indicator as to where all the stocks, derivatives are going to go. This is what's meant by yield curve control. It's a case of determining what actually is involved in the bond market. What is the bond market? This is where we need to really drill down and understand what's going on in the bond market and as to how it's going to affect stocks, cryptos, commodities, you know, how it's going to affect these markets, forex markets. Well, look, bonds really have two elements, okay? It's premium and yield. Premium has a price. It's around, I don't know, premium's around $100, $150 for a bond, right? Or is that? We'll have a look at that shortly. And the US yield, which is what we follow closely because that tells us what's going on, is a percentage, and that is about 2.88%. It might have dropped down a couple of basis points. If we start seeing it moving up and down 10 basis points at a time, we know that something's amiss there. That means that there's a sell-off in the bond market. Okay, if it's dropping lower, there's a sell-off in the bond market, which brings down the prices to entice more buyers, supply and demand. Okay, so really, supply and demand is one thing that affects the price of bonds, but also the Federal Reserve is the other. The Federal Reserve set the rate of interest. Okay, if they're doing anything meaningful, things can get way out of whack. That is, the Federal Reserve decide that nope, this quarter 2% instead of 0.2%. Okay, that will just, the markets will just not like that. Everything will sell off and we'll have some major economical crash. You can almost guarantee that. In fact, that almost never really happens. I mean, if you see back in the 80s, there may have been some action like that. However, I digress. Investors buy more bonds in times of bad economical prosperity. Okay, so if their forecast models tell them that no, this is economically bad, like raising interest rates, high inflation, then we can get this reversal. It will go on for a period of time, right? So really, investors in times of bad, in times of when the economy is bad, investors like to move into bonds, okay, because it's like a safe haven. It's like gold. All right, human psychology, perhaps. Okay, investors sell bonds when indicators show that the economy is doing really well or is going to do really well. They sell off. Okay, don't forget, these bonds have time periods. Bonds can start from a year, 10 years, 30 years. Okay, so you sell your bond, you get your premium back, and you get whatever percentage rate that you've sold at that specific time. So if you sold when the 10-year yield was down at 1.6, you get 1.6 back. All right. Therefore, they will buy risk on assets in times of good prosperity, when the economy is doing well, like stocks, cryptos, things like that, because it's very stock market positive for bonds or the 10-year yield to drop. Okay, so this means when bond prices go up, the 10-year yield goes down. This is stock market positive again, but a side effect of stock market positivity is really inflation, and that is what you can expect. And this is when the Fed tries to step in with these yield control, or the yield, the 10-year, the yield control, because of the side effect, inflation. And so you see the complete cycle. But wait, what we got to think about is what information is proving this point that inflation actually reacts like that. Well, we can look at things like CPI data, okay, and the charts prove that without a shadow of a doubt. And really, I'll take you back to a chap back in 2021 November. He shows us where he was at in terms of the yield percentage, what that was at, and where we could be going. Cool. But I've really got to take you over to someone that can explain this. Just want to show you a segment of his video. You should check out his video, links in the description. Joel Warby, he describes this fairly fluently, so check out Joel Warby.
Now what I'm going to try and do is explain what has been happening to the bond market lately, and what does that mean for markets. Well, as we currently see here, looking at the weekly chart here of the US 10-year yield, we can see that previously it was working pretty stable, bouncing between 1.4 and 3%, call it, okay? It's done that a few times. Of course, then we had a COVID outbreak, and that's what's caused bond yields to plummet. But this is quite significant. Let's have a look at what's happened in the last couple of weeks. We broke back above that 1.4 level, and then we've tapped back into the 1.4 level once we kind of drifted up to the 1.6 level, of which we are at the moment. Tapped back into the bottom of that, the 1.4 level, and I've held that as a level of support. So very early on, you can start to see now that the potential is for this bond market to rise, maybe to fill that range again and head up back to the 3% level. Very important implications if that was the case. Now we wonder whether or not, is that just simply because, you know, are we just looking at technicals? Do we have any fundamentals to back that up? Well, quite usefully we do, because at the moment, just last week, we had CPI data come out for the US economy. The CPI data that was released was the highest in the 30 years previous, okay? So a new record for the last 30 years. Yeah, I think off the top of my head it was a 6.2 reading, and we can actually see that here to some degree. All right, we can see here, this is the CPI for the US, and what I've got here is a rate of change indicator, and what you can just see what's been happening is the momentum, the rate of that change, the rate of CPI has been massively increasing over the last few months. You can see that here. If I get rid of this arrow and this arrow here, you can just, you know, if I make that a line chart, you can just see how this is kicked up a gear much more previously to where it was rising steadily, had a little break, and now has been absolutely flying up. Now, just to note, that gives you an indication of the momentum that we have got rising at the moment in CPI data. If we look at the rate of change, that 5.53 reading at the moment, okay, try and put an arrow across the top of that, a level across the top of that, you can see that it was it's comparable to the last time that CPI was rising, inflation was rising at this level previously, was back in the 1970s, 1980s. So let's have a look at what did the bond market do, what did the yield on the US 10-year look like back in the 70s and the 80s. Now we don't quite have the data for the 1970s, just because TradingView's chart here starts in 1980 itself. What we can see though is that back in 1980 itself, the bond yield rose significantly. Right, rose from all the way at 9% all the way up to 15.7% before it started to drift off. So inflation rising typically gives you a good understanding that the bond yields could also rise significantly. The reasons for that is that, quite logically, for the Federal Reserve is to raise their interest rate levels. If CPI is rising, it's quite logical. You raise interest rates to try and cap inflation rising, getting it out of control. You don't want inflation to get out of control, so you make borrowing more expensive, and it means that people will hopefully not maybe spend money as quickly.
That's great, Joel. So where is this money going? We figured that out. It's going into corporate debt, housing debt. We're looking at a bubble in the markets, yeah. Housing market bubble, another economic crisis like 2008. We're already 20% above what it was back in 2008. What about the rest of the world, Joe?
It's because if the bond market, if the yield rises to 3%, essentially double to what it is now, then that means that all other debt in the world, their interest rate on that debt is going to rise, because all of the other debt in the market is in some way derived from the US 10-year bond yield. So you can be sure that if the US 10-year yield is rising, then you can be sure that the mortgage rates will be rising. You can be sure that all corporate debt's going to be rising, loans are going to be more expensive in the interest rate demanded from it. Everything else gets more expensive. So, gives you an indication of why this might well be a problem, because if we compare it to the last time that the US 10-year rose to 3%, we didn't have all of that debt that was created. Okay, so it simply means that now anybody with a 3%, even just 3%, of course, with the CPI, with inflation, if it really did run out of control, we could actually see this go much beyond that, but we'll just simply look at 3% for now. Gives you an indication though of why that is a potential problem. If debt becomes more difficult to service and people then will default on their loans, mortgages and the rest of it, there is a potential of that. It's not to say that will happen, it's just a danger of rising interest rates. So as we mentioned before, logically the next step for a Federal Reserve is to start raising interest rates, and we have got conversations at the moment happening between the Federal Reserve to actually see that happen, and there is projections for them to raise interest rates, to start tapering some of their economic support that has already been announced and is currently in place. So that is all to try and bring the risk of inflation running out of control in line, try and taper it a little bit, try and curb it a little bit. So that's not quite as easy as it sounds for the Federal Reserve to do, however, because if the Federal Reserve does raise interest rates, then they're going to start to cause the US dollar to rise in value, because once the US dollar has a higher interest rate from the Federal Reserve, then it becomes more attractive for people to hold their money in dollars than it does comparatively to, say, yen or euros or whatever other currency. You'll be more likely to hold your money in dollars. And once the US dollar rises in value, then that has massive implications for the rest of the market, such as commodities, stocks, and of course the currency forex market as well.
Okay, to summarize, we can see how Joel has predicted where the 10-year yield is going and what's happening with bonds and what's going to happen to the markets. What's going to happen next? That's the question for another video. So, over to you, Nathan. Let everybody know what to do. So, without further ado, if you enjoyed this content, you should join our community. Join zioncoin.org.uk. The link is in the description. Join a VABC project. If you're a developer and you like to develop new applications, there's a VABC project for you. Social media project for you. Think tank project for you. So if you've got ideas about applications that you want to build out, work with the devs and make it happen. If you just like blogging, there's a VABC project for you. So it's all free, it doesn't cost you anything, and you'll get free Zion coins. Now, don't forget to pick up a ledger or a Trezor, or even both. It's so important that you keep your assets on your own with your own cold storage wallets. Check out the link in the description. Pick up a ledger or both, a ledger and a Trezor. Become your own banks. You're going to need to check out this next video if you enjoyed this content. It's on the latest of Stellar XLM and Zion coins. And if you like this content, smash the Zion coin up there, like and subscribe. It helps us with the YouTube algorithm. And don't forget to share, because sharing is caring. I'm Nathan, aka Nathan of Zion. See you in the next one. Have a great day. Take care now.